I've come to Chinatown in London to talk about one of the big questions a lot of private investors ask themselves. How much, if anything, should I invest in China? The emergence of China as a superpower has been a remarkable development of the 21st century. The pace at which the country has modernised has had a huge impact on the global economy, as China has sucked in raw materials from around the world to build hundreds of new cities. The rise of China affects all our lives. I'm impressed that both my children are learning Mandarin at secondary school. That's something I could never have imagined when I was at school learning French and German. It makes me confident and excited about the future. Also, a colleague told me recently that in India, during Diwali, a lot of the fireworks that were let off during the celebrations were made in China. No wonder the country has got a reputation for being a factory for the world. So what investment opportunities does the China phenomenon present? Now's a good time to ask the question because the Chinese have just celebrated their new year. It's the year of the snake, or the black water snake to be precise. One of the attributes of the snake is that they're analytical. They're wary of diving into situations without carefully considering the facts first. That's fitting because it's the same approach investors need to take when looking at China. Funds investing in Greater China, which includes Hong Kong, Taiwan and mainland China, have done extremely well in the past 10 years, as China has grown to become the second biggest economy in the world after the US. These funds have achieved an average total return of nearly 360%. That's really impressive, but bear in mind that stock market returns and economic growth are not always directly linked. Although China's economy has posted impressive annual returns each year, for example, last year it grew by 7.8%, its lowest in a decade, the stock market, meanwhile, has been volatile and is still 60% down on its peak in October 2007. There are two big positives about China's current situation. First, the most remarkable aspect of the China story is the fact that its capitalist revolution has been overseen by the Communist Party. However, there is considerable potential for instability in this vast country as its 1.3 billion population encounters new wealth and increasing inequality under one-party rule. There was relief last year when the party managed a once-in-a-decade change in leadership without too much trouble. Li Keqiang is due to take over as premier in March. Secondly, China's economy seems to have managed to avoid a hard landing after years of rapid growth. Recent figures showed that trade is improving, with both exports and imports up. This is good news for the rest of the world. However, there are problems. China's massive investment in infrastructure has created a property bubble and left many of its state-owned lenders with bad debts. There are also concerns that Japan's recent success in driving down the value of its currency, the yen, may affect China, either crimping its exports or raising its inflation. And speaking of Japan, its recent dispute with China over the Senkaku Islands has raised the risk of military conflict between the two old rivals. Few people have any idea of what goes on inside China. On balance, with fingers crossed, most analysts think its economy will continue to do well. The really important thing to know about China is that it's going through another transition in which the dominance of state-led investment is replaced by consumer spending. This creates investment opportunities in technology, retail, leisure, tourism and finance as the Chinese become more Western in their outlook and spending habits. The fascinating thing about China is that you don't have to invest there to exploit these trends. You can invest in the Greater China funds I mentioned earlier. Alternatively, a slightly less risky way is to invest in funds investing in the Asia-Pacific region. This covers countries like Thailand, Indonesia and the Philippines, as well as China. However, investing in emerging markets like these is always high risk. A less risky way is to buy into a UK fund investing in British companies seeking to grow their business in China and Asia. To sum up, it's impossible to say how much you should put in China. However, you can safely say that it's a theme that investors cannot ignore.